All right, so you and me are on. Okay, what I'm going to cover with you, Debbie, is how you kind of go about figuring out what product to write on a client. And it's a lot easier than you think. And let me kind of click out at some of my stuff here. And I'll use some of my PowerPoint since I spent all this time on it.
Oh man.
I'm kind of in a little bit of a, I've been putting it together, so I'm almost close to being done, but I think it'll still work out real well by showing you how this works. So the product, like I said, that I like working with is CFG because it's very simple. The software, or not even, it's not even software, it's a spreadsheet quoting tool, and um, and they've been paying like crazy, like been paying like very fast. So can you hold on? Let me catch this call. Just a second. Oh, anyway. Okay, so let's go through this. So the companies, when we underwrite a client, the companies that we use, we start off with, if it's just in general, the ones I want you to learn is the CFG Safe Shield mortgage term product, the simplified issue whole life product called Dignified Choice Classic 1 and 2, and then simplified guaranteed issue whole life, the Kemper Life product. But you can only write it if you live um, in states that are not these states. Okay, so if you're in Alaska, California, Connecticut, District of Columbia, Delaware, Hawaii, Massachusetts, Maine, Minnesota, North Dakota, New Hampshire, New York, Rhode Island, Vermont, and that's pending with Montana and Maryland, you cannot write it. But if you're, because you're in Florida, you can write Kemper. So really, between these three products, you'll be able to write like 99% of the clients you run into. So this is really all you got to learn right now. I mean, some of the other products might have certain strengths, but we'll get to those, later. This is all I really want you to focus your attention on. Okay, so it really starts, Debbie, with the lead that you're going to be running. And so kind of the products in mind, like when you run a mortgage lead, the first thing we're going to try to do for them is we're going to see if they qualify for the Safe Shield mortgage term product. If their health is such they cannot qualify for that, then we're going to try to put them into the Dignified Choice whole life product. And then if their health doesn't qualify them for that, then we know that we can get them covered for Kemper. Okay, so for a mortgage lead, those are the three products that we want to consider. For final expense, it's a lot easier because we're just going to stay with the CFG. Um, and I'm finding errors on my own PowerPoint. So the final expense, we try with the Dignified Choice product and then the Kemper Life. And we probably won't typically look at the Safe Shield term product. If the product's a new marriage lead or a new birth lead or a speed lead, which is an internet lead, these folks are typically looking for life insurance that will take care of their specific situation. It may not necessarily be whole life for the final expense, but sometimes it's just regular life insurance. Well, in this case, we're going to sort of treat it like a mortgage lead. We're going to look at covering them with Safe Shield first, and then maybe Dignified Choice if they can't fit into Safe Shield or Kemper Life. If they're specifically looking for final expense, then we're going to treat it like a final expense insurance. So it really kind of depends on what they're looking for. So again, as long as you have these three products, if you're knowledgeable in writing those, then you're going to be pretty good there. Okay, the only products that you're going to need for underwriting for the CFG term product for Safe Shield is the Safe Shield Agent Guide, okay? And then the CFG SIT stands for Simplified Issue Term, which is another word, that's another title they use for the Safe Shield. You can see the title here though, Safe Shield Simplified Issue Term Unacceptable Risk. So between these two guides, you can determine whether or not your client can fit into the product. Okay. Now, so let's take, for example, this mortgage lead of a client who, Daryl and Nika, which I actually wrote a policy just recently. Um, so the vital information, first to determine if you can write them on a CFG Safe Shield because it's a mortgage lead, is first of all, what is their height and weight? We want to make sure that their height and weight fits into the standards, and their age. Does their age fit into the standards for CFG Safe Shield? And then the loan amount is relevant only so that we know if it'll fit within the guidelines, which typically it does, but it's something just to look at so we know what we're dealing with. So let's say we're consider running this appointment on September 29th of 2013. So that makes Daryl 31 years old and Nika is 24 years old. And then his height and weight, he's 6'3", 250. She's 5'7", 150. Okay, so with that information, what we're going to do is the first thing we're going to do is we're going to check to see if their age range fits into the product. Okay, so we're going to check age first. So we go to the product guide, and it's page 2 of the product guide, and it says here, as I blow it up here, you can see the issue ages. So since his age of 31 and her age of 24, they fit within the age guidelines for both the 15-year version, the 20-year, and the 30-year version of the product. And then also this section here is the Safe Shield return of premium programs, a 50% and 100% return of premium programs. So it shows here their age ranges fit within the 20-year non-tobacco, the 20-year tobacco for ROP, the return of premium, and the 30-year as well. And then the amount of $53,021, you can see that the issue amounts are $25,000 to $250,000 for both. So certainly we can fit it within there, but the minimum is $25,000. Okay, so we see that the issue ages fit, the issue amounts will work as well. Now we check to see the height and weight. Okay, so the height and weight you can find on the SIT Unacceptable Risk Guide, page 2. And so this is what page 2 looks like. And here you can see the guidelines. So he's 6'3", 250. So you go to 6'3", and the maximum weight's 340. So he's well within the guidelines. So he's acceptable. Then she's 5'7", 150. So you see here 5'7", 271. So again, she's well within the acceptable guidelines. So it's looking pretty good that we can probably get them into this product. So let's look at the additional health information. Now remember, when you're booking the appointment, you want to find out, do they have any prescription medications, and find out the reason for taking them. Do they have any operations or overnight stays in the hospital? And then the big 4, I call this the big 4. You ask them, do you have any problems with heart, diabetes, stroke, or cancer? Any of these problems will knock them out of the term product. And then if they're smokers, I want to find out what tobacco they use. Is it cigarettes, chewing tobacco, pipe, etc.? Because it just gives me a little more information about them. In this case, the clients are non-smokers. So what I'm going to do is I'm going to check all this information against the SIT Unacceptable Risk Guide to determine if their conditions are acceptable or not. And Daryl, since he's on no medications, he's had only a knee operation for a football injury, clearly he's acceptable. And then Nika's only on birth control, and she's on no other medications. Okay. Now let me show you what that document looks like, so you get you're familiar a little bit with the Unacceptable Risk Guide. So here's what that looks like. Okay. And it's just a 2-page document. You can see again, this is a height and weight. And so when you read it, you can kind of see that blown up a little bit. It says here the following risks are unacceptable. So AIDS-related complex, HIV, alcohol treated. So this is in the past 5 years, been advised or reduced to stop alcohol, and it shows the parameters, age 18 to 65, less than 4 years since treatment. Okay, if they're more than 4 years, then they can get into the product. Again, these are all unacceptable risks, so if they're within these parameters, they can't get the product. Alzheimer's disease, dementia, asthma, if moderate, severe, then you can't get it. If it's mild asthma, then they can get into it. What's the determination? Moderate to severe asthma typically means that they've probably been in the hospital. Hospital emergency room visits, especially recent ones, that's pretty much severe, you know, or a smoker without complications, a bedridden, cancer in the past 10 years, other cancers less than 5 years. So you got to read through this. Coronary artery disease, heart attack, heart surgery in the past 10 years, criminal history, stroke or TIAs, degenerative muscle and nerve disease disorder, diabetes. Now remember, insulin diabetic, you got to read through here and see exactly what the parameters are, whether they're rejected or accepted. Type 2 diabetes, same thing. So pretty much this chart, this document will guide you, okay? Now, if you have any other questions, if you're not sure about a client, you can always call and get a risk assessment, okay? And the risk assessment number, let me pull that up, for CFG is the main phone number, 1-800-423-9765. You just call them up, tell them you're looking to get a risk assessment from an underwriter, and then they'll hook you up with an underwriter. Then you just tell the underwriter everything that you know about the client: age, height and weight, smoking status, their medications, and then the underwriter will be able to give you an idea of how to deal with it. Okay, so this is the unacceptable risk guide that you're going to need to determine if a client can get into it. Then the other document that's a good document for you to have is that other document, which is the Safe Shield term insurance guide. These are all on the website, and this gives you more of the parameters, sort of like the rule book for a game. You can see here I blew that up for you on the height of the issue ages. It's got everything here all listed out that you can look up. So this is what you kind of see what talks about the riders. This is the disability occupational riders that are uninsurable. So the disability income rider goes through which occupations they cannot cover. Explanation on how to fill out the application. I mean, this is a really good document as your guide to work with CFG in this product. All right. So that is those are the two products in determining the underwriting health situation. Okay. So next, what we're going to do is we're going to figure out calculating the options. Now, since they both fit into the underwriting guidelines, we're going to try to figure out some options to choose from. So here's what I'm going to do is I'm going to put together some quotes for the client, and so let me show you how we do that using the spreadsheet. Okay, and so when you pull up the CFG quote calculator, if I can do it here. Jeez, you're kidding. Okay. Here it is. All right, this is what it looks like. Now, if you look at the bottom here on the tabs, you can, FE stands for final expense. That's the dignified choice product. SIT is the simplified issue term product, the one that I'm going to quote for the client. Then you got this single premium whole life, which is actually going away, I think the middle of October. Okay, so let's focus on the SIT product line. Now, remember that I'm a big fan of putting together the quotes so that the client, so we have choices that we can give the client. And I like to prefigure a bunch of quotes before I go in. Now, I'm not going to put it on any presentation sheet. What I'm going to do, Debbie, is I'm going to put it on the back of the lead in like little crib notes. Okay, just so that I have the rates there that I can pull from that, but it's not something I'm going to show the client. I'm not going to show them like 15 different quotes. I'm going to focus primarily on some very specific things. Now, the client, as I mentioned, his let's see. Okay, so he's like 5'10", or I'm sorry, he's what's his age again? Yeah, okay, he's 31 and she's 24. Okay, so what I do is I turn my lead over, and oh yeah, and then I gotta take down what's the mortgage amount is 53,021. So I'll just put it down for just to make it an even 53,000. Okay, and when I called them, I found out that it was a 30-year term. So they got a 30-year term on this 53,000. Actually, I'm sorry, it wasn't 30. It was 15. It was a 15-year term policy. Okay, so so let's go to the. So let's. They're in Ohio, so I'm going to pick Ohio. Okay, now I'm going to just do a stripped down version of this for him. I'm going to do the non-return of premium, and then I'm going to do it for 15 years because that's what they got. His issue age, last birthday is 31. He's a non-smoker. I want to quote monthly. Okay, 53,000 is his mortgage. And I'm just going to do a stripped down version of this. That's all the basic, a 15-year term. So I'm going to write down on my back of my lead, I want to run a 15-year, and I'm going to do a basic 53,000 basic death benefit program. So I wonder if I could do this. Okay, so I'm going to type it out here so you can see it. But what I do is I write it on the lead. But I kind of want to see sort of how I set it up in a table so I know what I'm looking at. And can you see that all right?
Yep.
Okay, great. Okay, so what I'm going to do is so this is Daryl. Okay. And then this is the basic benefit of 53,000, 15-year term. So you can see that 15-year, 53,000, it's $12.09. Let's put $12.09. And
what is modal premium?
Modal, that means it's monthly. It's the one you pick. That's the premium mode is monthly. You can do annual. So total modal premium, the annual premium is $138.97. The semi-annual is $72.27. And then the monthly modal is $12.09. I like to quote monthly. So does that make sense? Okay.
Okay.
Now notice, you didn't see quarterly, did you? CFG does not do quarterly premiums. Um, they
Okay.
they only do EFT. They do EFT for all three: annual, semi-annual, and monthly. If the client says, "Well, I don't want anyone have access to my bank account," well, then the other alternative is they get billed. They got to pay semi-annual or annual. Now, for an older client, it's going to be cost prohibitive. So, but you don't have any choice of CFGs. So they won't do quarterly billing. So you got to use all your sales skills to sell the client that the CFG is not going to steal their money from them. And I just say, well, this is the way they do it. So let's just and I don't even address it. I just say this is how they do it. Period. All right. So you got the basic program of $12.09. It's a stripped down program, and then it seems like pretty affordable for this age. So what the next thing I'm going to do is I'm going to say, well, why don't we put an option for 50% return of premium? Okay. In fact, let me I kind of write this down where I can understand it. This is 15-year term. Okay. Now notice here that when I put 50% return of premium, you've got the requested benefits in the yellow and then the allowable benefits. Okay. Notice that in red it says 20. Basically what that's saying is there is not a return of premium available for a 15-year term. You can see that down here as well. It says here down here at the bottom, 15-year non-tobacco and tobacco, 50% ROP and 100% ROP not available. So I'm going to have to show the client this 50% return of premium rate of $16.65, but I look at it as a bonus. I go, for $16.65, they're going to give you a 20-year. They're going to cover you for 20 years, which is cool. And the amount you're going to get back is half the premium amount. So you're going to get almost $2,000 back. So it's like paying $8 a month for your policy. So I kind of give them the feeling like you're getting a mega discount if you live to the very end, because you're going to get half your money back. You're covered for 15 years, so another 5 years you're going to be covered for $53,000. So if you pay your mortgage off early at 15, you still have an extra 5 years. So in case you die, Nika's going to get $53,000 to help her move on in her life. So I spin it as a positive. Okay, does that make sense?
Yes. Yeah.
Okay, now I'm going to show them a third option. The third option is, well, why don't we cover 100% return of premium? So the 100% return of premium, you can see, is $40.85. Okay, it's a lot more money, but they get their entire money back on it. And so this is a 20-year 50% ROP. And then this is 20-year 100%. Now remember, I'm just writing this down so that I can just easily pull it off the back of the lead. All right, I'm just typing it out for you just so you can see sort of what my table looks like. Okay, so I've got 3 different options that'll cover a variety for them. And then, I showed that they're going to get $98.05 back and at the end of 20 years. So it works like a savings program. Okay, but it's going to cost more. So I'm not trying to overemphasize one or the other. I'm just saying what it does so that they can make a decision. But I'm not trying to sell the highest one. Trust me, I want the lowest one they can afford. Okay, so if it's $12 a month, then God bless them. I'm covering for $12.09. Okay, so I'm going to do the same with Nika. Okay, Nika. She is 24. Okay, 53,000. So I'm going to go back starting out with non-return premiums. That's $11.40 a month. Okay. Then I'm going to do the 50%, and that's $12.59. And then 100%, that's $32.55. And so these are the options that I feel pretty good about because it's very affordable. It's something that they can, I think they can handle. And then, you can add them up so they can see kind of what their budget is. And, for a new couple starting out, they bought their first home, we can't automatically assume that, $7,340 a month is affordable. I mean, it may be affordable to you and me, but it's a client. But I'm not afraid of showing the client the value they get for $7,340. They get all their money back. But as in most cases, people always like the middle option. And that's what they picked. They picked the middle option. And it's like, amen, hallelujah. Thank you, Lord. They picked something they can afford. Again, it's not about how much they pay. It's about I get them covered. So they picked the 2924. I wrote it up. Life's good. Okay, so that's how you do the rate sheet. Does that make sense?
Yes.
Okay.
Do the rate sheet at home and put it on the back of the lead sheet.
Yes, yes. Now, if you have to, if they ask for some crazy, like like for example, she says, well, and this typically doesn't happen, but if he says, well, what's a 30-year program cost? they won't typically ask that, but if it's not something you prefigure, then you have to pull your laptop out. I don't typically get that. I just might do it though. I might prefigure a 30-year term and just tell them, look, it's better to have it and not need it than need it and not have it. This can transfer to another mortgage. Okay, so maybe what I do is I do the same scenarios, except I do 30 years. Okay, and then I redo all these for a 30-year program. So I have somewhere to go. I always have somewhere to go. I'm not going to show them all this, but I'm going to show them maybe, which ones I want to show them. Because here's a problem with over showing or showing too many rates is it'll lead to a think about it. You know what I mean? They're just going to say, their brain is so fried with so many choices that they're just going to want to tell you to think about it. Does that make sense?
Yes, because they're too baffled because you gave them too much.
Exactly. So I'm trying to make it simple. I want them to only choose between 3 options. And then they, of course, will pick the middle one mostly. So I show a high amount, medium, and low. I show them, like, I'm not trying to show them something for $73.40 and then another one for $70, another one for $65, just thinking I'm going to get them a higher premium so I can make more money. I'm a big believer in showing them significant differences. And even though this isn't significant from $23.49 to $29.24, the reason why it is significant is it's one of those for only $6 more, you get half your money back. And that's the easiest close is because $6 to get half your money back, it totally makes sense, doesn't it? And they say,
I'm going for the 6 spot.
yeah, they say, yeah, that makes sense. So at least we do something. And the other thing is when they got a return a premium on it, chances are they're going to want to keep it because they don't want to give up the money that they quote unquote saving with it if they lapse it. So they have a higher motivation to keep it in force. Okay. So that's the mortgage protection lead for a younger person. Let me show you what happens when they're older. Okay. So let's okay, so we're just here. Okay, so let's take an older couple. Okay, an older couple that turned into mortgage protection lead. It's a $55,000 mortgage. We got Lance and Ruth. And Lance's date of birth is in 1943. Ruth's in 1948. So they're an older couple. So he's 70 years old as of September 29, 2013. She's 65 years old. He's 5'10", 165, 5'4", 155 is her height and weight. And so we do the exact same thing we did for Daryl and Nika. So we're going to look at their age and see if it fits. So under the age guide, say again?
How much was their mobile?
55,000. So we check his age, he's 70. Well, when you look at the age table, there's nothing he qualifies for. So immediately we know he doesn't qualify for this product at all. So then we're going to check her age. Her age is 65. Looks like she can only qualify for the 15-year term here, and that's it. The non-return of premium version of SafeShield. And then their mortgage amount of 55,000. Certainly it fits within the parameters here. Okay. Okay, again, we check height and weight. Since he can't qualify for the product, I'm not going to look at him, but I'm going to look at her 5'4", 155. Obviously, she fits and she's acceptable. Okay. So here's some other health issues that I found out from them. She has a hypothyroid condition. She takes Synthroid medication to help her thyroid. She's also on high blood pressure medications. Lance's situation, he's taken a blood thinner due to a stent that he had in one artery about 12 months ago. And he's also on blood pressure medications. So those are pretty common things for people when they get older. Okay. So I'm going to consider all those health situations. Now, time to calculate the option. Ruth, so let's take a look at Ruth's, check Ruth's underwriting guidelines. Okay. So let me back up. I think this might be out of order. So let's check Ruth against the underwriting guidelines. So we look up on the SafeShield Simplified to Determine Acceptable Risks. And we see that out of all these issues here and on page 2, her conditions of synthroid or hypothyroid and her high blood pressure is not even called out here. So she's good to go with the SafeShield product. Now we got to check on Lance. Now Lance, since he can't get into the term product, then the next option is to look at the final expense dignified choice whole life product. Okay, and so we look at two things to determine Lance's qualifications health-wise into this product. We have the reference guide available to us, and then the actual application will dictate what he can get, because the application in sections 1 and part 2 will determine what he can get. So let's take a look at that for him. So the product guide for dignified choice looks like this. It has the contact information and just general information here. Again, it has the issue limits. So does his age fit within the age limitation for Dignified Choice Classic 1? Now, Dignified Choice Classic 1 is a full benefit program that's immediately available right away. So his health has to be good enough to fit into Classic 1. If it's not, but he still can fit in Classic 2. Classic 2 is a graded benefit whole life product where if he dies within the first 2 policy years, like it says here, they're going to return their premium he paid plus 6% interest, which is a tax-free benefit. Okay. After 2 years, then the full face amount is available. If he dies in an accident, then the full benefit is available anytime after we put this policy in effect. All right. The actual application will determine which one he can get into, which will then determine what rates we run on him. The issue limits, you can see his age of 70 fits within this band here, 2,500 to 25,000. If he does Classic 2, the graded benefit, he's 70 years old, so you can see that being 70, he can get as high as 15,000. But when he hits 71, then it limits to 10,000. Okay, so that's what the product guide will do for us. It'll determine, kind of the age range, and there's underwriting guidelines in here as well. But really, the product application will determine it for us. Let's look at that. So here's the application for Ohio. And let me blow it up. So it's got all the basic beneficiary information and product stuff. But here's where we got to really check. So this part 1 right here, Debbie, if he answers yes to any of these, then there is no way we could cover him with this product. And if we can't cover him with this product, then we're going to go to Kemper Life, because we can't cover him with Kemper because it'll cover anybody. Okay, so let's read the question. I'm sorry?
Do you have him fill out the form, or do you just sit there and ask him questions, and as soon as you get a yes,
Yeah,
you go?
never, ever, ever give a client the form to fill out. Never.
Okay.
You're required to fill it out the way he wants you to fill out legally, but don't give it to them to fill out. I always think that that's just, everyone should know that, but I'm glad you said that, because I've had agents give the form to the client to fill out, and it's like, oh my God, didn't you know that? And I realized, no, they didn't. So, great question. So,
So you sit there and you ask them the questions.
yes, and then you check off.
As soon as you finish the list, you go to Kemper.
Exactly. So this is your checklist, and but when they give you the information over the phone, then you know kind of what you're dealing with when you're going in. That's what we like to ask for health issues on the phone. So the part 1, you can see, is the proposed insured currently hospitalized, confined to a nursing home, hospice bed, or confined to a wheelchair due to disease or chronic illness, institutionalized, receiving home health care, ever been recommended for an organ or bone marrow transplant, ever had a heart, lung, liver, bone marrow transplant, ever had an amputation due to disease, or within the last 12 months received kidney dialysis. Okay, this is like, knockout questions totally. You can tell too. This you got to be pretty sick not to get this. The second question is related to AIDS or a terminal medical condition to result in death over the next 12 months. Number 3, be diagnosed with or receive treatment for mental retardation, Down syndrome, cerebral palsy, muscular dystrophy, spina bifida, cystic fibrosis, sickle cell anemia, or unoperated heart defects. Number 4, has a proposed insured ever been diagnosed or received treatment? And notice here, treatment includes taking medication for congestive heart failure, Alzheimer's disease, dementia, Lou Gehrig's disease. During the last 24 months, has a proposed insured been diagnosed or received treatment? Again, including taking medication for any form of cancer other than basal cell skin cancer. During the last 12 months, has a proposed insured been diagnosed as having a heart attack? And then finally, the height and weight table is just a question. Are you a male over 350 pounds, or are you female over 300 pounds? Okay, so that's the knockout questions. If they answer no to all these, then we know they qualify for either Classic 1 or Classic 2. Part 2, the next section, determines whether it's Classic 1 full benefit or Classic 2 graded benefit. Oops. So Part 2 is, during the last 13 to 24 months, has a proposed insured been diagnosed as having a heart attack? During the last 24 months, diagnosed as having a stroke, including a TIA, aneurysm, enlarged heart, angina, pacemaker implant, or any procedure to improve circulation to the heart or brain. Procedure to improve circulation could be putting a stent, okay? It could be a heart bypass surgery, anything that they do to improve circulation to the heart or brain. During the last 36 months, been diagnosed or received treatment, including taking medication for the following. These are the lung-related stuff: emphysema, COPD, chronic obstructive pulmonary disease, black lung disease, chronic respiratory disorder, excluding asthma or sleep apnea, or used oxygen equipment to assist in breathing. B, kidney disease, kidney failure, liver disease, chronic hepatitis, drug or alcohol abuse, or systemic lupus. Systemic lupus is different than the other kind of lupus, whatever that's called. Multiple sclerosis, Parkinson's, schizophrenia, brain tumor, or has a proposed insured been hospitalized or institutionalized for mental or nervous disorder in the last 24 months? During the last 24 months, has a proposed insured experienced complications of diabetes? Okay, so it's not diabetes per se, but it's any complications resulting from diabetes, including insulin shock, diabetic coma, retinopathy, which is the problems with your eyes, nephropathy, problems with kidneys, neuropathy, problems with your nerves, or circulatory disorder, or diabetes not under control with current treatment, or has the proposed use insulin for treatment of diabetes prior to the age of 50. So 50 is kind of a magic number for that. If they answer yes to any of these, then you got to run the graded benefit Classic 2 rates. If they answer no to these, then it's the Classic 1, which is the better rated product. Okay, so so that's how simple it is. It's just figuring out what to answer on here. Now, for our client, Ruth can go with the simplified issue term, but I might run some rates on her for dignified choice too, just any, just to have it. And then we can run quotes on Lance for the dignified choice, but notice that for Lance, his problem is he can't fit into the system, the SIT product, but let's see if he fits in the whole life. Now remember, his situation was he's on taking medications for blood thinner due to a stent that he had 12 months ago. So that's a procedure to improve circulation to the heart. So going back to the questionnaire, part 2, part 1 he passes, part 2, during the last 24 months, has he been diagnosed as having, and then we say improved, or any procedure to improve circulation to the heart or brain. So that means it's 12 months ago, so that means he's only eligible for the graded benefit product. Okay, so I'm going to go back to my software, and I will choose, now I'm going to show you 2 ways to do this. This is not as easy as the rate chart, but for her, okay, so let's do Ruth, and I'm going to see what she can qualify for. So let's do just a strip down non-return of premium. I think their mortgage for $55,000 is a 15-year mortgage. She's 65. 55,000. Whoops. Golly. Okay, so basically 15-year term for 55,000. That price is $111.93 a month. So that's kind of up there, right? So what I'm going to do for her is I'm going to bring it down. So let's say I'm going to stick it over here, and then I'm going to bring it down. I'm going to stay with 15-year because that's all she can qualify for. But I'm going to go like maybe 40,000. Okay, find out what how much 40,000 is. So I'm going to drop it down to 40. Why 40? I don't know. It was just a number between 50 and 25,000. So again, it brings it down pretty significant. 82, 82. So it's 20, 30. That's like $30, $40 less. Okay, so that's a significant drop. And then I'm going to do the minimum, which is 25,000. So 15-year, 25,000, because that's the minimum. Because I want to show, look, it's half the mortgage, right? He gets some retirement, so does she. if she dies, he can refinance the home by half, and so the mortgage payments half. So, whoops, that's I'm sorry. That's 5372. Okay, so that's a pretty good range of options for her, right? It'll get her, she may like freak out at 111, but at least we can bring it down to 5372. And then another thing we could do is maybe we can add an accidental death benefit rider that will double it. So if she dies in an accident, okay, so that's 5744. She's got 25,000. So this includes accidental death benefit of 25,000 in addition if she dies in an accident. So this is a good option for her if she has, if she's concerned about covering the whole thing. Does that make sense?
Yes.
Okay. So I think we got Ruth down here. So let's talk about Lance. What do you do for Lance? Well, look, Lance is in a situation where he's got a lot of illnesses to deal with. And so we're going to have to go to what we call the mortgage payment protection idea. All right? Because it's going to be more expensive for him, we can't possibly cover the entire mortgage. But what we can do for Ruth is maybe she can get maybe a year's worth of mortgage payments, and their mortgage payments like $400 a month. Okay. So what we're going to try to do is we're going to do this maybe I don't know, let's just be conservative. I'll just price this out. 6 months, 12 months, 18 months, 24 months, 30 months. Let's just kind of see. I like to have all these just for grins, right? So so this would be a benefit of 6 times 4 is 2,400. 12 months is going to be 4,800. 18 months will be the two added together. That's what 7,200, right? And 7,200. So 48,6, 8, 9, 9,600 is 24 months. Okay, then 3 times 4 equals 400 times 30, which is 12,000. Okay. All right. So so I'm going to figure out the rates for 2,400 for him. So this is in Ohio. So this is I chose the FE for final expense. This is a dignified choice. Okay. Now since it's graded, I'm going to look at it over here because it's the graded benefit, not the full benefit. The full benefit's here. I'm going to look at the graded benefit over here. So he's in Ohio. I always choose the state because I want to make sure it's available in the state that I'm writing it in. Male, he's 70, non-tobacco. So let's put in 2,400. Okay. Well, the minimum is 2,500. So right away, we got to bump it up to 2,500 because that's the minimum. Okay. Whoops, 25,000. 2,500. Okay, so 2,500 for the graded benefit is $3,830 a month. So for $3,830 a month, we cover 6 months of mortgage payments. She could fix the house up to rent it out or fix the house up to sell it. So it gives her time. It buys her time. Okay. Let's go figure out for 4,800. That's 1 year, and the price is $70.32. Okay. 7,200. Whoops. Is 103.74. 103.74. 9,600 is 137,7015, and then 12,170.56. Now remember, I'm running this back on the lead, on the back of the lead. I might not show her that because he might have a heart attack right there. I don't want him dying in front of me. So, but I have it there because sometimes they'll say, well, I show them like 18 months, and she might say, well, what if I needed 30 months? I got 30 months. What if so I'll have something more. But I may not show it all. I may, I just show the bottom three, honestly, is probably what I would do, is I would show this for Lance. Okay. So probably something reasonable, maybe for them, is she gets, maybe, he might pick $70, and she might pick this one right here, 57. That's 120 something. Equals this plus that. So $127 a month. But that might be tight for their budget. Maybe it's just 38 and 53. But at least I have something to show them. But I'm only going to show them 3 options each. I'm not going to try to show them more unless they ask. Okay, does that make sense?
Yes. Now, can Lance have accidental also or no?
Let me see. Oh, you're right. He can. So he can do the same thing. He can double the benefit. Oh.
No, it says not a.
You know why? Because his age. He can't. His age is he's too. It's not allowable because he's too old. If he were younger, then he could probably get it. It shows right here. Okay, so again, check the software. It has the chart here. Accidental death benefit rider available for age 45 to 65.
Yeah, and even under Classic 2, it has the NAA in those lines. I didn't notice that.
Yeah.
Up the right, top left, right.
Yeah. So there you go. So we got them covered. Now, what do you do for final expense? Final expense, you're pretty much doing exactly what you did for Lance, except it's for what they can qualify for. So, maybe they both are Classic 1, and then I just do, 2,500, 5,000, 10,000. But I always start somewhere around 10,000 because 10,000 is what the average funeral costs. So I'll do 10,000 and then below that, 10,000, maybe 7,500, 5,000, somewhere like that. Because 5,000, you definitely can probably get a cremation up to 10,000. So 5,000, 7,500, 10,000. And so how we did it for Lance is how you do it for final expense. Okay. Now let me show you the rate chart because the rate chart rocks. Let me tell you, it's so easy. And I gotta sign in, I think. Yeah. So let me show you how you would go and actually get the Dignify. So the apps and forms, for the Dignified choice, you just click on this link for the apps, and then for SafeShield apps and forms, it's right here. Okay, and then the calculator is downloaded right here. Premium calculator. It says SI term premium calculator, but you can see it covers all 3. The final expense, the SIT, and the single premium whole life, which again is going away in October. So to download the rate sheet, just click on that and yay. So let's go to Ohio. This wasn't working before, but it's working now. Okay, so this is all the forms you need to write this product. You don't need all these forms, but here's a base application. You need that. Let me tell you what you absolutely need. You need replacement form. Always print that out because you don't know if they're going to come up with the fact that they have another policy. So always print that one out. Here's your agent reference guide I mentioned. Base application, HIPAA authorization. Oh, by the way, Classic 1, the level benefit program, requires a telephone interview. And so the telephone interview is what you call it in after they sign their form, and then you tell them that the client or that the company is going to do an interview. They're going to ask them the exact same questions that you just covered. And this telephone brochure will give you that information on the telephone interview and the number that you call in. And I like the telephone interview because the telephone interview tells you right away if the client can get covered. And you can see that the interviews here are available Monday through Friday from 8:30 a.m. to 12 a.m. That's like midnight Eastern time. And Saturday and Sunday from 10 a.m. to 8 p.m. Eastern time. So you just call this number and then they'll prompt you with questions. And that's how you do a telephone interview. Remember, it's only for Classic 1. The level benefit program is when you have to do it. The graded benefit, you don't have to do a telephone interview. Okay?
So do you call while you're in the house with the client?
Always. Always. And I do it on my cell phone, on a speakerphone. And I put the form in front of the client so they can read along. And I point to the answer when they're supposed to answer. Because some of these older folks, they're a little bit slower, so you want to make it easy for them. Now, do not verbally coach them. Like, make sure you answer yes. If they hear that, they're going to end the interview and they're going to decline your client. That's why you have to, you have the sheet in front of the client while they're answering the question. You're pointing to the question, and then with your other finger, you're pointing to the answer. And you just so that it doesn't get hosed up, because man, it can get crazy because the client can't hear the telephone interview real well. You just want to make it easy. That's all I'm saying. Now, here's where you download the rate tables. So the EFT rate tables rock. It's right here. Let me show you what it looks like. So you don't have to go through the software. You just pull off the rate tables, and it tells you exactly what the monthly premium is going to be. And it's downloading right now. It's pretty large. That's the only problem with it. And it's multiple pages, so you're going to have to print it out. But I don't know. I like the ease of just looking it up. So this is what the document looks like. So notice, female non-tobacco, 2,500 to 13,000. Just look at their age on the left, then go to the right up to 13,000, and you can pick out the monthly rate. Then the next sheet has it from 14,000 to 25,000. Okay, so you got to make sure at the top that you're in the right place. So our guy is a male. This is female tobacco, male non-tobacco. So this is where our buddy would go. And 2,500 to 13,000. He's 70. So right here, I would look at these rates right here, and you just pull it off. It's super easy. Male non-tobacco, male tobacco, graded benefit. So this is the graded benefit version, female. Graded benefit version, male. And that's it. So you just print this out and you're good to go. And you don't have to, pull out your laptop or whatever. So it's pretty easy with the rate table sheet. And that's how you download the applications for the Dignified Choice, the Safe Shield term apps. Can you pick the state? You don't even have to log into the website, so it makes it super easy to download the apps you need. Again, you need the application, you need the accelerated benefit rider disclosure form, replacement form. You actually have a rate book for Safe Shield as well. but I don't think it says easy. And then here's the agent guide down here. Let's click on it and see what it looks like. I mean, if it's as easy as the other one, I'm like all for it. But I think it's just you have to multiply stuff. Yeah. So you got to multiply the amount of insurance and then the rate and then multiply the modal factor. I mean, if you can do it, God bless you. I mean, it's fairly straightforward, but I just use a calculator. But you can't. I mean, if you read through it, it'll teach you how to do it. I'm not going to teach you how to do it now, but that's if you want to do that. So the forms are easy to get to, and so that's it. Makes sense?
Yes. Now to put it into action.
Right, right. So again, going back, what you do is you take the lead, and then you determine the height and weight. You determine if it fits. You turn to the age if it fits, and then you consider the health. Does the health fit? If it doesn't, then we got to go with the next one. So if it's the term, if it doesn't fit in the term, we're going to go to the whole life. Final expense whole life doesn't fit in the whole life. We're going to go to Kemper, and the Kemper is easy peasy. So if you're in those states, you can write Kemper. You just go to Kemper. The Kemper download apps and rates here. So you pick you pick the state-specific applications and forms. Go down to Ohio, and then this is all like gobbledygook here. But the application, you almost have to kind of open them all up. But HHC is home health care, so that's not it. I think it's this one. I mean, I'd recommend downloading all of them and taking a look at it. Okay, so here's the application form for Kemper. It's super simple because it's guaranteed issue. They don't really care about the client's health. They just are signing them up. So you choose the policy amount. Do you have existing life insurance in force? Will this insurance plan replace? This is the whole replacement idea. Do you like to pay delinquent premiums pursuant to the automatic premium loan provision? Always check yes. That means if they don't pay their premium payment, they're going to take it out of the cash value. So you always want to check yes here. Do you understand that the reduced death benefit amount may be payable during the first 2 policy years according to the terms of the policy? This is a graded benefit, very similar to the other one. It pays 120% of the return of premium during the first 2 years, and after 2 years, it's all fully available. Okay, it's a very simple 2-page form. Now, how do you find the rates? It comes off the brochure, which I think is this one right here. No, it's this one right here. Yay, got this lovely gentleman and his wife. And the rates are a rate table. There it is. So let's zoom in. Okay, so our guide, let's say he couldn't qualify for that. CFG 2, Classic 2. So age 70. You go to this age 70 and he's eligible for these rates here. You can see they're quite a bit more. And these come in 5,000 increments. So male 5,000, 10,000, 15,000. So male 5,000, he's eligible for the rate of $60.07 for 5,000. 60. So let's take a look at what. See, so, oh wow, it's cheaper. Oh, but this is the graded benefit. So the Kemper is actually cheaper than the CFG graded. So you can figure out what you want to do. it could be better to do the Kemper. The only thing with Kemper is that, well, Kemper's a great product, so I'm not going to say anything. Sometimes you have to kind of check. So that's kind of what you're dealing with Kemper. Plus, they pay 120%, whereas the other one pays 105%, I believe. So it's a little bit less. That's kind of the nature of the beast. All right. So Debbie, makes sense to you?
Yes, it does. Thank you so
Great.
much.
And